Hello and welcome. You're watching this special budget expectations interview on ICICIdirect.com, the budget of hope as it is being called. I'm Siddharth Zarabi, and with me today, one of India's leading economists, Ms. Shubhada Rao, the founder of QuantEco Research. Wonderful to have you again on the show after a long time, Shubhada, and I hope you got some time to go through the economic survey. And I'm going to begin our conversation today with a question that came straight to my mind from the survey. The survey projects a V-shaped recovery. The consequential question out of that is, if the recovery is V-shaped, at least according to the government economists who write the survey, will the government policy makers in the same ministry, the finance ministry, therefore conclude that there is no need for a fiscal stimulus, the economy is getting repaired on its own?
That's a very good point. Thank you, first of all, Siddharth, for having me on the show. It's wonderful to reconnect with you after such a long gap. Always a pleasure interacting with you. Coming to your question, we too are expecting a V-shaped recovery. In fact, we were perhaps one of the earlier ones who projected a recovery in terms of growth going to about 11.5% in the coming fiscal year, that is fiscal 22. Now, taking a leaf out of economic survey, if the government is already acknowledging a V-shaped recovery, does it really need to continue to, administer additional fiscal stimulus? In our opinion, yes, because if we look at, in conjunction, the 2 years, we would have seen a contraction of close to about 7.5% in the fiscal 21, and in fiscal 22, even if you look at 11% or 11.5%, on a net basis, we are looking at a cumulative growth of just about 3% Is this good enough for an economy which has an aspirational growth of 7% plus? Perhaps not. What we really believe is that the government may need to continue its counter-cyclical fiscal stimulus to nurture growth even further, not just in the near term of fiscal 22 that we will see the budget unveiling measures for, but embedding and instilling some reforms which actually start yielding outcomes in terms of improving growth rates in the subsequent years as well. So that is the reason we believe that the counter-cyclical fiscal stimulus, which began in May of 20 through Atmanirbhar programs and like, we may need to see a continuity and further building up of these kind of stimulus measures.
The second point, and I've been discussing this with several private sector economists like yourself, and the first point there is a low growth versus low deficit. If I were to ask you to expand on that, because if low deficit becomes the priority, you will have, in this current situation, low growth. What would you therefore hope for from the government policy makers in the budget?
No, absolutely a very valid question. Globally also this is getting asked. But importantly for India, we've had, a slippage in fiscal deficit for past 2 years in particular. Therefore, this debate came to fore as to should we cut back and retrace in terms of fiscal expansion so as to get on to a fiscal credibility path once again. To this, the question is, we've gone through an unprecedented 100-year kind of a phenomenon where the growth impulses had actually frozen in the first half. And it's only in the second half that we've seen a turnaround in recovery in high frequency indicators and so on. While we definitely want to get onto the fiscal path, but it has to be in touch with, in the context of the current reality, which is that we continue to nurture growth. Because let's not forget that once growth takes off, the nominal GDP improves, there would be better consumption capacity jobs are going to get created, and it will then unleash a virtuous cycle. But if we are completely absorbed and obsessed by maintaining low fiscal deficit, we are actually subduing the growth multipliers in the economy. So in this context, obviously, like most of us in the breed of analysts and economists, we would believe that growth must and needs to take precedence. However, one should have a revised, a reset glide path for the FRBM to set it out, because it's important. While the near term, the importance has to be assigned to growth, whereas when we are designing a fiscal consolidation map, it also needs to bear in mind that we do not erode and endanger the future potential of growth, and that would happen by being responsible, by creating smarter design of expenditure in the current budget.
Yes, smarter design.
Absolutely. We need a productive kind of leanings of expenditure. We need a maximum bang for the buck where the government spends money. And that is why, while fiscal deficit can get wider, our own expectation is that it will be at 5.5% of GDP, which is 200 basis points likely to be lower than the current year. But however, it is important that how the government spends will be critical to pave way for future growth impulses over the next 3 or 4 years.
That's a good point, and you used a very nice term, smarter expenditure. And before I ask you a detailed question, just a quick comment really. On what side are you on? There are people who are calling the current phase, the current data, normalization. There are people saying that even the GDP numbers have been, based differently, and that set of people says the recovery is yet to start, and we have the economic survey making a categorical assertion about a V-shaped recovery. What's your call?
We believe that recovery is taking shape, Siddharth, because if we look at high frequency indicators, obviously we need to have a more microscopic way of looking at things. And where I come from is just critically evaluating where the manufacturing sector has been in terms of output. And if we look at the data more closely, there would be obviously pockets which are continuing to undergo stress. Textiles is one segment that I would believe that it hasn't come out of it, or petroleum products and so on. Some of the core industries haven't completely come out of stress. But if I look at the wider universe of the manufacturing products, it gives me a fair degree of confidence that a host of industry items are actually already touching pre-COVID levels. And this is the data pertaining to November. So I do believe that there is
a recovery, right,
evidence, on a recovery taking shape.
Okay. Now the question arising from your comment about smart expenditure, would you therefore say that the budget has to very, very clearly set in motion and begin what, like you said, a multi-year cycle of public investment being crowded in?
Yes, absolutely. I think we need to have a healthy switch to capital expenditure vis-a-vis revenue expenditure. Fiscal 21, obviously, the urgent and immediate need of the hour was to escalate revenue expenditure, to put money into the hands of people. But that was for fiscal 21. This is the time the government can afford to switch to a more productive kind of expenditure, capital expenditure. Social sector spending is one such element that comes to mind. We need to have significant ramp up in health expenditure, which seriously lags behind even our emerging market peers. We are less than 0.5% of GDP where we assign health allocation to health. We need to ramp it up to 3 or 4% over a period of time, but we at least need to make a very solid beginning. That is one. Second is, of course, like budget after budget, we continue to give thrust on infrastructure, job creating expenditure. But this is the time probably that we need to have a clear focus on creating job kind of impulses in the economy, which would essentially come through spend on infrastructure, to spend on, a newer services kind of digital push. You have various PLI schemes. You need to create an ecosystem around which you just need to follow it up with all the announcements that you made in the preceding year. So clearly, a 22% of increase in capital expenditures, that what we are aspiring to see in this budget, and hopefully I'm sure the ministry is equally and perhaps not even more seized with this fact that we need to now get on to productive expenditure.
Productive expenditure. That's a good point. Coming back to the point about growth, and I'm toggling on this issue because as we come to the final part of our conversation, we'll try and address that. But the recovery and the base effect is going to play out in FY22. That's very clear. The question is, what about FY23 and beyond?
Absolutely. No, that's a good point to be concerned about at this juncture. We are all, projecting a double-digit growth. If we cancel out the first half of the previous fiscal year, that is the fiscal 21, and the first half of the forthcoming fiscal year, we will see a deep cut giving a bounce, exaggerated bounce back in the first half. If we cancel out those and look at a second half of the fiscal 21 and second half of fiscal 22, that is going to provide to us more meaningful inputs in terms of where the growth momentum is actually picking up. And to that, I believe, Siddharth, that while manufacturing has seen a quicker, smarter, sharper turnaround than most of us envisaged it to, it is the services sector which actually has been until now lagging behind, and that is where we see a significant improvement because as anecdotally, Mumbai has begun its locals now, the lifeline supposed to be. This is the kind of anecdote that we would look for, that now the unlock phase is completely done with. It's more or less back to normal with, of course, safeguards in place regarding precautions taken. But if we are going to quickly get back to normalcy, it's the services sector we believe will have a much stronger and smarter turnaround. So second half, we will see about a growth of about 6.5% to 7%, which is a sensible, respectable, meaningful growth. To your question of where does it take us to in beyond 23, 24, I think, Siddharth, it's very important to see how the budget is, pushing on its reform agenda. And that cannot be, given up in terms of the immediate needs. We need to keep the sight over improving, issues that constrain capital inflows, that constrain direct investment. We have to seize this opportunity for China plus kind of a model. India is a naturally attractive destination. India needs to create a reform-based ecosystem so that we are continuing to attract capital, and that would pave way for growth to get back to 7.5%, 8%. Now, one such thing is, year after year, we talk of asset sales, privatization. But I think this is the best opportunity that government has been offered. That on revenue side, if we look at what is the most critical part, we will see tax revenues bounce back as economy picks up. But critical would be what is the government thinking on actually delivering on the asset sale agenda, and on the expenditure side, the switch, as I talked of, capital expenditure, and more importantly, social sector spending. Reforms are needed. We cannot have a Atmanirbhar program without paying enough heed to India becoming a very critical player in global supply chains. Protectionism, a sensible way of protectionism, yes, but not a one-size-fits-all kind of a protectionism. We need to make sure that we do not escalate our costs, which are on imports, which actually are used for re-exporting. So we need to devise policies, designs, which actually are in sync with, taking India to a 7 to 8.5. I mean, 8 sounds a bit too much of a dream at this point in time, but even a 6.5 to 7.5 would be over the next 3 years would be a humongous achievement, in my opinion.
I think, Shubhada, all of us need to continue to dream, because that's what hope is all about. And in these times, dreaming is not escapism, according to me.
No.
Your point about structural reform is well taken, because conventional fiscal and monetary policy alone cannot perhaps suffice after such a huge, unprecedented shock. My final couple of questions really. How important is it to fix the financial sector? Because to me, that seems to be the single biggest continuing risk to our macro stability. I know the budget cannot do it, but it's a question beyond the budget, really, Shubhada.
Siddharth, you actually preempted my response, that one critical element that the government, the RBI need to together collectively focus on is how to quickly bring in the risk appetite back into the financial sector. Just as a quick, a rear view mirror kind of sight is that we have had 3 unprecedented big events in fiscal 17, 18 and 19, which actually culminated in growth coming to about 4% in fiscal 20. The first year we had a demand disruption in the form of informal sector grappling with the post-demonetization impact. It of course had positive factors to look at, but there was a demand disruption. The subsequent year, we had a process disruption in terms of the GST, where a lot of formal sector was grappling with streamlining their GST procedures. And the third and most critical disruption came through supply of credit after the shadow banking crisis. Now, these 3 events actually led to slowing down. And the third one was the most critical one, because that's where the risk aversion started to creep into the financial sector. And that is where we believe that 2 elements that I fully support are the creation of bad bank. Is somewhere I do believe that banks need to get unshackled by the prospective deterioration of asset quality once the moratorium is done, and AQR, as was being recommended by the economic survey, if it does indeed get taken up, there will be a need to look at a banking sector devoid of a chunk of bad assets, and that can happen if there is a creation of bad bank. So I personally am I do support a creation of bad bank. The second would be also I do support the creation of DFI kind of an institution, because the need of the hour is infrastructure. The need of the hour is long-term, funding. The question is, it's not just stopping at a creation of a DFI. I think the entire loop has to be closed as to how are we going to source funding for this long-term development finance institution. Are we going to look at some global capital flowing into that DFI kind of a structure that government, if it does propose, something like the sovereign wealth fund, something like pension funds, that could come in terms of on the source of funds. And then of course you have a huge infrastructure need to bridge, and that to me would be more efficiently done by a DFI. Now, these are the 2 institutions that I would like to see getting created, and that could get introduced in the budget. As far as RBI is concerned, RBI has done the heavy lifting of supporting growth the past year. We've seen interest rate support, liquidity support to forbearance, etc. The question would be, how long does one continue with the booster dose and adrenaline? Because come next year, that is the calendar year 22, we could see some noises coming out of the developed central banks in terms of timing of when to take stimulus gradually. That's the time RBI will have to be doubly prepared with all its ammunition. So in our opinion, RBI could start, while it will remain accommodative, it could start examining, exploring some kind of a normalization towards the January, March of 2022. And that's where we could see that RBI will need to step in to prevent any shocks in the monetary and the financial markets. So overall, I would think this year, government has to take up the leadership role in getting the growth back on track.
Okay, that's an important point. And in the last 30 seconds that I have, just one quick response. And I know this has been a subject that is a core area for you. You and I have discussed this for years. Inflation outlook, quick answer if you could, please.
It's definitely going to be lower. We believe it's going to be much lower than this year because all supply shocks will get addressed. We're looking at a 5% or 5.5% to 5% average band. For the simple reason, core inflation will be looked out for as commodity prices are rising and demand starts to pick up. But having seen the idiosyncrasies of these supply shocks getting out of the system, we are obviously going to see a much lower inflation coming into the fiscal 22.
All right. Shubhada, as always, it's been brilliant talking to you, and we probably get to see if any of what we have discussed actually finds a mention in the general budget. But like you said, the topic, hope is what drives all of us.
Absolutely.
And it's a wonderful budget. And, thank you very much once again for your time.